welcoming to the stage for this discussion Philippides, CEO of Mashreq Capital, Dr. Sameh Torgoman, founder and CEO of Evolve Investment Holding, EIH, Ahmed, Abou, Saad, Head of Regional Asset Management, Minat at Azimut Group, and your moderator, please welcome back Stephen White, Senior Conference Manager for Forbes Middle East. Please welcome your speakers.
No microphone there, that's good. Good afternoon, everybody. And thank you for the introduction there. I mean, I'm so pleased to have such a stellar lineup of speakers with me this afternoon. Yes, it is a highly volatile market, global market, and we're going to make sense of some of that from an investor point of view in this session. Philip, if I can start with you. I mean, in this period, this era of high volatility across markets, I mean, it must be very difficult to make sense of it all from an investor point of view. But, I mean, how are institutional investors rethinking their approach, particularly across asset allocation? There's obviously probably more choice than ever in terms of where you can put the money, if you like. But if you could just take us through how you make sense of that and perhaps pass on some advice to some of our audience here.
Sure, and thank you very much. It's a
Thank
pleasure
you
to be here, and thank you for having,
it's wonderful to have you.
having me. So look, I'll just start from the beginning. I think the key asset allocation for many decades has actually typically been a balanced 60-40 equity fixed.
It's been easy, isn't it?
It's been quite
too
easy, right?
easy.
And ultimately, that's served investors quite well over the years, right? So you can put a lot of other things to it, but that's done well. Even in the last 10, 15 years, that's done well, but everybody's aware that there's higher correlation. It's done well just because everything has been going up. And that can't happen all the time. So especially after the global financial crisis, what you saw with the correlations that went from 20 years ago, 0.4 equities fixed income to 0.7, people started to diversify, and they diversified quite a lot more in their portfolios into moving into private assets, equity, fixed income, credit, infrastructure, more into commodities and so on. And ultimately that is to try and create a strategic asset allocation whereby you have a goal of what you're trying to achieve, and to get there, the more alpha drivers you have, then you're more sure to get there with a smoother journey, with less volatility.
But surely some of the risks of some of those new asset classes you're talking about is that they're not known quantities. We'll talk a little bit about investing in gold in a moment. But obviously some of these are very recent asset classes. I mean, take us through sort of some of those, what those risks are potentially in terms of investing in newer classes or opportunities.
Look, ultimately, you're going to invest in something because you want to get some return. So a lot of the private assets that have seen quite a big boom is that, number one, they're not marked to market, which means that they somehow insulate your portfolio a little bit from that volatility. And you're also getting what's called the illiquidity premium, because you can't get out of some of these positions for some time. And they've actually done well for investors. Now, of course, you've got other things which are coming in, which is cryptocurrencies. And it's a brand new asset class that's been around. And we've seen those come into portfolios. And again,
they can't fit neatly into your old models of risk models or evaluating.
So I think people are still figuring out,
Yeah.
and we're still at the early stages of how you can model that. But for sure, we've seen from private individuals now to institutions and governments actually putting those as part of their asset allocation. And I think investors are doing so as well. Volatility, as something comes down and as it gets regulated, so volatility of Bitcoin 15 years ago was quite high, right? If you had the risk appetite, you would have done quite well. But now it's actually come down, a lot a lot more, and as it gets more adopted, it'll continue. So it can serve as part of a portfolio alongside, but the key thing is exactly this, is what do you put in your portfolio? What is your strategic asset allocation? What are you trying to achieve? What risks are you trying to do? But I think the key thing that's changed in this market, and volatility actually hasn't gone up hugely, if you look at the VIX or the implied volatility.
That's something people might not necessarily assume.
Exactly, but what's driving, historically you had fundamentals driving the markets, but now you've got geopolitics, sentiment, news flow are actually becoming a much bigger factor in portfolios, and therefore your tactical asset allocation needs to be more dynamic and maybe take a bigger part of your portfolio if you want to try and capitalize on that.
Dr. Sameh, if I can come to you, thank you very much for that, Philip. I mean, I guess when we talk about market volatility, I mean, we talk about the global economic crisis, and also you've been a massive architect in terms of building up capital reserves of gold inside Egypt. Obviously, there's a market that for a while was, in terms of its currency, was all over the place, but obviously you found another route through all of that volatility. And I just wonder, sort of, how do you approach diversification across these asset classes? And obviously, you still want to make sure your portfolios are aligned with whatever your long-term thematic or structural growth trends are in your own market or globally.
Well, thank you, and thank you, Philip, for what you just explained to us. And I think just to add to what he said, when you look at the markets and look at the challenges that are facing the global economy, the regional economies, and all this, what investors used to think are goes without saying, like the 60-40 you mentioned, the rule and all this stuff, is challenged now. It's you are facing, like I always say, it's a perfect storm.
Yeah.
You have technology change with the AI happening, is controlling and now dominating the investment, and what this will happen after the AI. Many jobs could be vanish and all this stuff. Many companies could vanish. And then you have the geopolitics. And then you have, which is more important, the global markets, how the global trade have been going for the last 30 years and 40 years is vanishing. Now we are talking about tariffs. Now we are talking about the role of the world.
It's a very different world.
Extremely different world. So when you look at this, one of the things that we thought about it in Egypt for diversification, just to be back to what you said, was gold, because we thought in this time that this was 10 years ago, that gold will come to play a significant role as a hedging mechanism and in the portfolio. And when you look at what's happening right now, is there is always have to be an anchor that people need to relate to, and it's a global, in my opinion, a global currency, and it's well recognized through all the centuries. So we created the ecosystem for it in Egypt. It was not that before, is to help the investors to diversify. But I think what will help the investor to diversify more is understanding the risk that they are we are facing, because risk is the main name of the game that all in whatever you are in the investment, whatever type of investment you're doing, if you know how to deal with the risks that you are facing, then you will be able to hedge against it. So from our perspective, we thought that the main hedge that are wanted to work accordingly is the currency risk. We not only the local currency risk, but the global currency risk. So we created the funds for gold, and we started our first fund with partnership with Ahmed and Azimut. So, and it went well, and it went beyond what we expect. And we are thinking about other products, because we believe is, in my opinion, diversification will be the name of the game. And it's not about now equity and just debt instruments. It's about different world that we need to change, and there will be different ways to hedge
But in such volatility, how easy is it to work out what you're going to buy and hold versus what you might want to speculate on? I mean, it seems very tricky on the outside.
Well, in such a volatility, I think the main difference will be your capabilities to understand these changes extremely well and make decisions that what you think will be the winner at the end of the day. Because we are in a phase equivalent to other phases that have been in history where there are major changes and major shifts are happening. Usually, if you stick to what you are used to know, usually you will fail.
Yeah.
So there is a new era is coming.
So being conservative, holding on is not the way to do
need
it.
to build your capabilities of understanding the world better and an open eye, because there are many blind spots in these markets right now that you are not witnessing very well, and there are many changes that is happening. Some changes we recognize, and other changes will be coming massively in the near future.
I guess one of the things, we talk about change, one of the things that I think is fundamental is this concept of democratization investment. Even allowing younger savers, younger investors to actually enter the market. And I don't know whether or not looking at those particular people or people entering into the investment world, it's like how can diversified products offer, transform or offer them an opportunity to become long-term shareholders? Because obviously, they might be building up their first portfolios, and if they're sensible, they're going to be thinking in the long term. So, I mean, what advice do you give to those people?
Well, thank you very much for your question. However, let's talk about it from two angles. The first thing is diversification was well known as don't put all the eggs in one basket, while the institutional portfolio construction process itself is far beyond that cliche. Simply, diversification is not about count. It's not about number of assets or what you have. It's about how you combine assets together, assets that they don't share the same risk drivers, the same liquidity profiles, the same cash flow resources. So that's very important, because your ultimate aim is how to protect your downside, and amplify your compounding returns over long period of time and in different market cycles. That's it. That's why the strategic asset allocation has to be set in place, and that's why a review has to be done periodically, and you have to be disciplined in the tactical rebalance, if I can say so that you get away from the greed and panic type of the game. Again, so that's we do from an institution. But inside, we don't have to forget that we have also to diversify in each sub-asset class. Like whether in sectors, whether if we're talking in equities, whether in geographies, whether in fixed income, we're talking about tenors. This is something that is extremely important. However, I cannot do this to everyone. I can do this to deep pockets. I can do this to institutional money. But in order to try to offer this and to democratize this, what we did is that our mission is to try to transfer the real-world assets into financial products. And then these financial products has to come in the form of mutual fund. And then to find how to distribute these funds to be accessible to everyone. So that at least
to have a return for them at some point, right?
Yes, exactly. So at least now you can offer the full, diversification bouquet to everyone. And they are receiving, they can receive the same service as an institutional investor. But however, I believe with the technology that Dr. Sameh just mentioned, here is what comes next, is that what will help people, and this will not be replaced.
AI? You talk about AI?
You name it AI, you name it robotic, you name it AI, agentic, you name it, whatever game, and it will not be replacement to the asset manager.
You think the asset manager's job is safe? Is that what you're saying? What do you think, Philip?
Look, I think there's an evolution, right? Their asset managers are incorporating AI, and an asset manager isn't today isn't going to look like an asset manager in 5 years or 10 years at the end of the day. So, and the way that we're looking at portfolio managers, if you just look at how we consume research, why do people give asset managers money is because we have an institutional process of gathering and analyzing information to make better informed decisions, right? Now, if people have that AI themselves, what's the role of an asset manager?
I guess it's just to manage the AI.
Just throwing the cat out there, right?
AI.
But exactly. But then the asset managers need to harness this to actually provide more. So when an analyst could actually do 50 companies, they can now do 200 companies or 200, or they could go across.
It's a huge
so
upgrade.
it amplifies what you can do, and you have to evolve.
Have to evolve? What do you think?
Well, when he mentioned about the AI, and Ahmed was saying that it's whether the AI will be replacing the asset management or not. I think there will be many changes happening. And, we evolve on digital and technology, and because we believe that technology will be changing, changing, and it should be changing everything. I think what we need to think about is AI is a tool at the end of the day. And I think it would be a major mistake to look at AI as an enemy for many people. And I think successes will be how you master the AI world and how you build new ideas that will be helping you to be in a position on that. But I think it's a very challenging world, and
But is the secret to develop the most diversified portfolio you possibly can, or is it this perfect balance or blend?
I think it depends on your risk appetite. At the end of the day, it is what you would like as a return over the long term, what you're trying to achieve, that will dictate, and the risk you want to take, to dictate what your strategic asset allocation is going to be, the asset mix that you're willing to take. So the
goal is the same, right?
It is the same
it has been,
with different, exactly. However, then you need to have the right engine and the right risk model to select the right ingredients to get you to where you need to be.
And I think it's the most important is how to identify the right risk is extremely important.
Just if I sorry.
Yes. Well, again, I think the role is important. I think I'd love to AI to take the less senior functions.
Have you ever tried that? Have you ever tried it?
Yeah, of course.
Yeah, and
of course.
What was the results?
It's lovely for me. Like I'd love to take all the hassle, all the administrative, all the analysis, all whatever, and let me focus on how to make money. How to make money for my investors, how to make new products, how to avail new asset classes. Because again, the 60-40, I can say, and I'm not sure everybody can be with me on this, but the 60-40 died already. There is no 60-40. What's 60-40? Which 60, which 40? Which asset classes? Is it equity and fixed income? Now we're having private markets, whether private debt, private equity, precious metals, we're having alternatives. And don't forget the sleeping beast, which is the digital assets, which is coming.
I mean, from my side, I think this is about the most exciting period it could be to be an investor. I mean, I don't know if that's something you see. I mean, there are so many options. I mean, I guess there's too many options, maybe. Philip, you're nodding.
Look, there's a lot of options. And I think what's amazing is there's a lot more investors. Everybody can invest on their app. And they can start a lot earlier. And they can know a lot more and have a lot more information. So absolutely, it's exciting.
Okay, well, that's a nice upbeat way to finish on time as well. So that's even more upbeat. So thank you very much to my panel. Thank you very much. Round of applause, please.
Thank you.
Thank you, gentlemen.